Welcome to the AlJazari channel, where you will learn capacity planning as a core operations management activity. In this video, capacity alternative evaluation using the break-even analysis method is explained. An organization needs to examine alternatives for future capacity from a number of different perspectives. Most obvious are economic considerations. Will an alternative be economically feasible? How much will it cost? How soon can we have it? What will operating and maintenance costs be? What will its useful life be? Will it be compatible with present personnel and present operations? A number of techniques are useful for evaluating capacity alternatives from an economic standpoint. Some of the more common are cost, volume analysis, financial analysis, decision theory, and waiting line analysis. Cost, volume analysis is described in this video. Cost, volume analysis focuses on relationships between cost, revenue, and volume of output. The purpose of cost, volume analysis is to estimate the income of an organization under different operating conditions. It is particularly useful as a tool for comparing capacity alternatives. The use of this technique requires the identification of all costs related to the production of a given product. These costs are designated as fixed costs and variable costs. Fixed costs tend to remain constant regardless of the output volume. Examples include rental costs, property taxes, equipment costs, heating and cooling expenses, and certain administrative costs. While the variable costs vary directly with the output volume. The major components of variable costs are generally materials and labor costs. The total cost associated with a given volume of output is equal to the sum of the fixed cost and the total variable cost. That can be mathematically expressed by this equation. TC equals FC plus VC, where TC is the total cost, FC is the fixed cost, and VC is the total variable cost. The total variable cost can be calculated by this formula. VC equals Q multiplied by V, where Q is the output volume, and V is the variable cost per unit. The shown figure shows the relationship between the output volume and the fixed costs, the total variable costs, and the total costs. Total revenue will have a linear relationship to output, as illustrated in this figure. The total revenue associated with a given quantity of output is the multiplication of this quantity by the revenue per unit and can be expressed mathematically as follows. TR equals R multiplied by Q, where R is the revenue per unit. The relationship between profit and volume of output is illustrated, where the profit is the difference between total revenue and total cost. The volume at which total cost and total revenue are equal is referred to as the break-even point, that is denoted by BEP. When volume is less than the break-even point, there is a loss. When volume is greater than the break-even point, there is a profit. Total profit can be computed using the formula P equals T R minus T C equals R multiplied by Q minus FC plus V multiplied by Q. Rearranging terms, we have P equals Q multiplied by R minus V minus FC. The difference between revenue per unit and variable cost per unit is known as the contribution margin. The required volume needed to generate a specified profit is defined by this formula. Q equals P plus FC divided by R minus V. A special case of this is the volume of output needed for total revenue to equal total cost or zero profit. This is the break-even point, computed using the formula. Different alternatives can be compared by plotting the profit lines for the alternatives, as shown where the concept of indifference point is illustrated. At this point, the decision maker would be indifferent between two competing alternatives. In the illustrated figure, a quantity less than the point of indifference would favor choosing alternative B because its profit is higher in that range, while a quantity greater than the point of indifference would favor choosing alternative A. Example: The owner of Old-Fashioned Berry Pies is planning to add a new line of pies, which will require leasing new equipment for a monthly payment of $6,000. Variable costs would be $2 per pie, and pies would retail for $7 each. Solve the following questions. A. How many pies must be sold in order to break even? B. What would the profit or loss be if 1,000 pies are made and sold in a month? C. How many pies must be sold to realize a profit of $4,000? D. If 2,000 pies can be sold, and a profit target is $5,000, what price should be charged per pie? The givens are: fixed cost, FC, is $6,000, the unit variable cost, V, equals $2 per pie, and the revenue per unit, R, equals $7 per pie. The first question is to find the break-even point, or QBEP, which can be found by solving this formula. So, QBEP equals 6,000 divided by 7 minus 2 equals 1,200. So, the answer is QBEP equal to 1,200 pies. The second question is to find the profit or loss if Q equals 1,000 pies. To do this, use this formula. Substituting by the given values, P equals 1,000 multiplied by 7 minus 2 all minus 6,000. This equals negative 1,000. This negative sign means loss. So, if they produce and sold 1,000 pies monthly, they will face a loss of $1,000. The third question is to find the quantity to make a profit of $4,000. To do this, simple substitute in this formula. Q equals 4,000 plus 6,000 divided by 7 minus 2 equals 2,000 pies. So, to make a $4,000 profit, 2,000 pies would be produced and sold. The last question is to find the pie price, or the revenue per pie, R, if they sold 2,000 pies and aim to obtain a $5,000 profit. Using the same formula and substitute by the given values. 2,000 equals 5,000 plus 6,000 divided by R minus 2. Solving this for our results in R equals $7.50. So, to sell 2,000 pies and obtain a $5,000 profit, the pie price has to be $7.50. After evaluating alternatives using the break-even analysis was explained using an example, let us solve some problems. But before starting, if you did not do yet, subscribe to the channel and activate the alarm to be notified of the new videos. Problem 1. A producer of pottery is considering the addition of a new plant to absorb the backlog of demand that now exists. The primary location being considered will have fixed costs of $9,200 per month and variable costs of 70 cents per unit produced. Each item is sold to retailers at a price that averages 90 cents. Solve the following questions. A. What volume per month is required in order to break even? B. What profit would be realized on a monthly volume of 61,000 units? C. What volume is needed to obtain a profit of $16,000 per month? D. What volume is needed to provide a revenue of $23,000 per month? E. Plot the total cost and total revenue lines. The givens are the fixed cost, FC, equals $9,200, the unit variable cost, V, equals 70 cents per unit, and the revenue per unit, R, equals 90 cents per unit. The first question is to find the monthly production volume at the break-even point, which can be found by this equation. Substitute by the given values. QBEP equals 9,200 divided by 0.7 minus 0.7 equals 46,000. So, the monthly production volume at the break-even point equals 46,000 units. The second question is to calculate the profit if the monthly production volume is 61,000 units. Substitute in this formula by the given values. P equals 61,000 multiplied by 0.9 minus 0.7 all minus 9,200 equals 3,000. So, the profit corresponding to a monthly production volume of 61,000 units is $3,000. The third question is to find the needed volume to obtain a $16,000 profit. This can be calculated by substituting the given values in this formula. Q equals 16,000 plus 9,200 divided by 0.9 minus 0.7 equals 126,000 units. So, to obtain a profit of $16,000, 126,000 units have to be produced. The fourth question is to find the needed volume to obtain a $23,000 revenue. We know that the total revenue, TR, equals R times Q. So, 23,000 equals 0.9 times Q, solving for Q results in Q equals 25,556 units. So, to obtain a revenue of $23,000, 25,556 units have to be produced. The last question is to graphically represent the total cost and the total revenue. To do this, construct the shown table using these two formulas. Then using Microsoft Excel, draw these two lines representing the total cost and the total revenue. In the second problem, two alternatives are compared. A small firm intends to increase the capacity of a bottleneck operation by adding a new machine. Two alternatives, A and B, have been identified, and the associated costs and revenues have been estimated. Annual fixed costs would be $55,000 for A and $25,000 for B. Variable costs per unit would be $9.25 for A and $12.50 for B, and revenue per unit would be $16. Solve the following questions. A. Determine each alternative's break-even point in units. B. At what volume of output would the two alternatives yield the same profit? C. If the expected annual demand is 14,000 units, which alternative would yield the higher profit? The givens are as follows. The fixed cost for alternative A, FCA, is $55,000, alternative B's fixed cost, FCB, is $25,000, alternative A's unit variable cost, BA is $9.25, the unit variable cost of alternative B, VB is $12, and the revenue per unit, R, is $16. For a better understanding of the problem, let us plot the lines representing the total cost of alternative A, the total cost of alternative B, and the revenue. It is clear that there are 3 points of intersection. The first one is the intersection between the revenue and alternative B's total cost. We call it BEPB. While the second one is the intersection between the revenue and alternative A's total cost. We call it BEPA. These 2 points are the answer to the first question. The third point is the intersection between alternative A's total cost and alternative B's total cost. We call it BEP, and this is the answer to the second question. I will show you how to construct such a graph using MS Excel after a couple of minutes. Let us mathematically solve the first question. In general, QBEP equals the fixed cost divided by the difference between the revenue per unit and the unit variable cost. So, QBEPA equals FCA divided by R minus VA equals 55,000 divided by 16 minus 9.25 equals 8,148 units. And QBEPB equals FCB divided by R minus VB equals 25,000 divided by 16 minus 12 equals 6,250 units. Consequently, the first question's answer is that alternative A's break-even point is 8,148 units and alternative B's break-even point is 6,250 units. The second question is to find the production quantity at which the two alternatives yield the same profit. This means the quantity at which the total cost of both alternatives is equal or the break-even point. Generally, the total cost, TC, equals FC plus B multiplied by Q. So, TCA equals FCA plus BA multiplied by Q, and TCB equals FCB plus VB multiplied by Q. Set TCA to equals TCB results in FCA plus VA multiplied by Q equal FCB plus VB multiplied by Q. Rearrange this equation and solve for Q gives QB EP equals FCA minus FCB divided by VB minus VA. Substitute by the given values. QBEP equals 55,000 minus 25,000 divided by 12 minus 9.25 equals 10,909 units. So, the volume of output with the two alternatives yield the same profit is 10,909. Let me explain something in this graph. We have 3 points and 3 different situations. In the first situation, the production quantity, Q, is less than QBEPB, which equals 6,250. The firm will face a loss as the revenue is less than the total cost of both alternatives A and B. While in the second situation where Q is more than QBEPB and less than QBEP, alternative B is recommended because it makes a profit as the revenue is more than alternative B's total cost. Note that between QBEPA and QBEP alternative A makes a profit as well, but less than alternative B's profit. And if Q is more than QBEP, alternative A is recommended as its profit is more the alternative B's profit. From this, we can answer the third question, which alternative yields higher profit if Q equals 14,000. As 14,000 is more than QEBP, so definitely alternative A will yield higher profit than alternative B. If you need to validate this mathematically, let us calculate the profit at Q equals 14,000 for the two alternatives using this equation. PA equals 14,000 multiplied by 16 minus 9.25 all minus 55,000 equals $39,500. While PB equals 14,000 multiplied by 16 minus 12 all minus 25,000 equals $31,000. So, at Q equals 14,000 units, alternative A yields a higher profit. Let us now learn how to represent the previous break-even problem graphically using Microsoft Excel. But before this, if you did not do yet, subscribe to the channel and activate the alarm to be notified of the new videos. We know that the fixed cost for alternative A, FCA, is $55,000, alternative B's fixed cost, FCB, is $25,000, alternative A's unit variable cost, BA is $9.25, the unit variable cost of alternative B, VB is $12, and the revenue per unit, R, is $16. Write down these values so you can follow me. Now open Microsoft Excel and create a blank sheet. Write at the top for cells Q, TCA, TCB, and TR as heading for 4 columns representing the quantity, alternative A's total cost, alternative B's total cost, and the total revenue. Using these givens to construct these 3 equations to calculate alternative A's total cost, alternative B's total cost, and the total revenue. Now we shall fill in the table with the required data to plot the graph. Go to the first cell under Q and enter 4,000, then in the next cell enter 6,000 and so on until 16,000. This range of Q is suitable to show the break-even points. The next step is to calculate alternative A's total cost, so, go to the first cell under TCA and write the total cost equation by entering equals 55,000 plus 9.25 times and select the first cell under Q, then press enter. Copy this cell format to the remaining columns cells to calculate TCA for different Qs. Doing the same for TCB, enter equals 25,000 plus 12 times and select the first cell under Q, then press enter. Copy this cell format to the remaining columns cells to calculate TCB for different Qs. Again, for TR enter equals 16 times and select the first cell under Q, then press enter. Copy this cell format to the remaining columns cells to calculate TR for different Qs. Now we have the required data, select them all. Go to the Insert menu. From the Charts area select the Scatter one, then select Scatter Lines. Here we have a line chart but need some formatting. Enlarge it a bit. Select the X-axis, right-click the mouse's right button, and select the Format axis. In the menu that appeared to the right, set the minimum bounds value to 4,000 and the maximum to 16,000, then close this menu. To give the axis a title, press the plus sign at the right of the chart, then select Axis Title. Select the X-axis title and write quantity in units. The same for the Y-axis title, write value in dollar. Select the chart title and write break-even analysis of two alternatives. If you want to change the line colors, select the TCA line, then go to the Format menu in the Shape Style, select the Shape Outline and select the red color. You can do the same for TCB and TR. Now the chart is ready for analysis, and it is clear that there are three different break-even points, as explained previously. The same procedures can be followed to graphically represent any break-even problem. Your feedback and comments are appreciated. So, give your comment to help us improve our videos. Break-even analysis is not only used to evaluate capacity alternatives, but also can be used to take buy or make decision, as illustrated in the following problem. A final product consists of several items. One of them can be purchased or made in-house. The manager needs to decide whether to purchase it or to have it produced in-house. Internal production could be done in two different ways. One with a variable cost of $14 per unit and an annual fixed cost of $240,000. The other with a variable cost of $17 per unit and an annual fixed cost of $200,000. 3 vendors are willing to provide the item. Vendor A has a price of $20 per unit for any volume of up to 30,000 units. Vendor B has a price of $22 per unit for a demand of 1,000 units or less and $18 per unit for larger quantities. Vendor C offers a price of $21 per unit for the first 1,000 units and $19 per unit for additional units. Answer the following questions. A. If the manager anticipates an annual volume of 10,000 units, which alternative would be best from a cost standpoint? B. For 20,000 units, which alternative would be best? C. Determine the range for which each alternative is best. Are there any alternatives that are never best? Which? Let us represent these 5 alternatives graphically using Microsoft Excel for better understanding. As we can see here, vendor B has the lowest cost at Q equal to 10,000 and 20,000 units. Let us verify this mathematically by calculating the total cost of each alternative at Q equals 10,000 units. In the case of producing the item in-house, the total cost equals the fixed cost plus the variable cost multiplied by the quantity. So, the total cost of the first alternative, TCA equals FCA plus VA multiplied by Q. Substitute by the given values. TCA equals 240,000 plus 14 multiplied by 10,000 equals $380,000. The same for alternative B. TCB equals 200,000 plus 17 multiplied by 10,000 equals $370,000. Now, calculate the total purchasing cost, which is equal to P multiplied by Q, where P is the unit price. For vendor A, the unit purchasing price is $20 for Q less than or equal to 30,000 units. So, TPCA equals 20 multiplied by 10,000 equals $200,000. For vendor B, he offers 2 prices, $22 if Q is less than or equal to 1,000 units and $18 if Q is more than 1,000 units. As Q equals 10,000 units, TPCB equals 18 multiplied by 10,000 equals $180,000. For vendor C, he offers 2 prices as well, $21 for the 1,000 units and $19 for any additional units. So, TPCC equals 21 multiplied by 1000 plus 19 multiplied by 9000 equal $192,000. After finishing these calculations, it is clear that vendor B has the lowest cost at Q equal to 10,000 units as we concluded previously from the graph. If we do the same calculation for Q equal to 20,000 units, we will get the same result, which is vendor B has the lowest cost at Q equal to 20,000 units. So, the answer to the first two questions is vendor B has the lowest cost at Q equals 10,000 and 20,000 units. Let us now answer the first part of the third question, which is determine the range for which each alternative is best. To find this, let us go back to the graph. It is clear that there is a break-even point at Q equals 60,000 units. While this area is not clear, so we need to focus on this area to gain more information. Here we have another break-even point at Q equals 1,000 units. It is clear that for a quantity less than or equal to 1,000 units, vendor A yields the lowest cost. While if the quantity is more than 1,000 units and less than 60,000 units, vendor B yields the lowest cost. And for quantities of more than 60,000 units, producing the item in-house using method A yields the lowest cost. Finally, are there any alternatives that are never best? Which? The answer is yes. From the answer to the first part, vendor A is the best for Q less than or equal to 1,000 units. Vendor B is the best when Q is more than 1,000 units and less than 60,000 units, and producing the item in-house using method A is the best when Q is more than or equal 60,000 units. So, the remaining two alternatives, which are producing the item in-house using the second method and vendor C, are never the best. In this video, break-even analysis is illustrated and used in different ways. If you have any queries, do not hesitate to contact me. Your interactions and comments are appreciated. In the next video, another capacity topic will be explained, so stay tuned and do not forget to subscribe to the channel and activate the alarm to be notified of the new videos. Thanks for watching. If you like this video, so press like and share it. See you again.